While markets have recovered much of the ground that was lost due to trade uncertainty in April, are there still more potential positive catalysts out there? Joining us now to discuss is Vitaly Mosinoff, Managing Director and Head of Fundamental Equity Research at TD Asset Management. Vitaly, great to have you back on the program.
A great pleasure to be back. I'm glad we're not just watching a live stream from the White House all day. So this is a good change of pace. Last month has been so volatile, so demanding.
What's interesting about when we talk about what we lived through in April and now that we're getting more firmly into May is that if you didn't pay attention in April, you might have thought, what was the big deal? Nothing happened. Everything was flat. What is going on?
56.59, April 2nd, right before you get the big announcement of Liberation Day. You remember that board?
Oh, yeah.
And then fast forward, you blink once, down 15%. You blink twice, 56.58 on May the 2nd. So today's it's an interesting day, May 8th. Victory in Europe Day, big occasion, big holiday. And that's, for humankind, a tremendous occasion. For the markets, it's all about that Liberation Day. So I'm hoping to unpack that today. A lot of things have happened last month.
Let's unpack it then. Obviously, in the middle of all that and trying to go through all that trade volatility, will they or won't they, tariffs on, tariffs off, we've been going through an earnings season. How is it shaping up in light of everything else that's going on?
Well, we've got a little table. If we can put that up on the screen, I think we do a really good job. Our empirical team summarizes all of the reporting throughout every reporting season for every single sector. There it is up on your screen. And so what you can see today, we're 84% of the way through reporting season. So we're pretty much done, right? Our analysts work so hard, long hours, and you can almost see the light at the end of the tunnel there. And what are we seeing? What are the results? Well, look at the very bottom line, the S&P 500, the market as a whole. Some pretty encouraging numbers there. 77% of companies have beat the expectations for earnings that existed the day before they reported. 61% of those same companies beat on sales expectations. That's the revenue column. Now, that looks really good. I would say it's in line with history. You're supposed to beat, right? So that 77% beat, that's normal. Next column, the magnitude of the beat, the 8.7% EPS surprise. How much did you beat by? Again, looks good, and it is good, but in line with history yet again. And finally, I think the best number there, if investors think about really compounding their wealth through the compounding of earnings and free cash flow, the streams of those companies that they're entitled to, well, 13.5%, 14% earnings growth, that's pretty good. That's something to take to the bank, led by healthcare, communication services, which is, of course, Meta and Alphabet, and then information technology, NVIDIA, Microsoft. So all good. The only caveat, Greg, I'm going to give you is the cutoff date for this reporting, March 31st.
I was going to say, some people will look at that and say that's all well and good for the 3 months that were behind us. March 31st is the end date. You get into April. That's when we really got into the thick of it. Conference calls coming quick and fast. Companies unsure about their outlooks. That can't be good.
It can't be good. And if you don't mind, I got another chart for this one.
Oh, yeah.
And it's another proprietary chart that our great folks put together. Look, companies are coming out there, and they have every incentive to get a little bit conservative right now, to say that Trump suspended these tariffs, but they might come back. There might be other tariffs around pharma, around semiconductors. We just don't know the future. So if you're management of a public company, you use this opportunity, maybe not to kitchen sink, but at least to get conservative, get you and me to take down expectations, right? And so what you see on this chart is really the manifestation of that. Every time a company reports and gives guidance or talks about the outlook, financial analysts go into their Excel models and change the variables, change the numbers, and then we evaluate, have numbers gone up or have numbers gone down? And that's really the way to read this. It can go between a +1 value and a -1 value. When that's a positive value and getting higher, that means we think the financial analyst community thinks the world is getting better. As you can see that throughout 2020, 2021, those were rosy times, right? Companies, business, fiscal stimulus, everything was booming. 2022, those were dark times for the markets, a mini recession, if you will, and you can see the earnings revisions turned negative. And then we've been chopping around, but what you can see through earnings season on the very right of that chart is there's some volatility, but really the values are pretty negative, right? And what that means is companies are talking about things in a way to give financial analysts an excuse or to steer them in the direction of taking down their numbers. So what's the end result? 13.5%, viewers might recall, was the growth rate of Q1 earnings. Today, expectations have come down so much for Q2, more than we've observed in 9 out of 10 years, in fact, that we now think Q2 earnings will be just 5%. So you're going from 14% to 5% growth. So that's what's happening. It's the outlook that's really weighing on the financial models.
And yet the markets continue to go up despite all of that. What is going on there?
Yeah, it's quite a disconnect. Now, there's three things I'll say. One is the markets are not stupid, usually not stupid, and they understand the very dynamic that I described to you, that businesses have every incentive to be conservative.
To lower the bar.
Lower the bar.
And then maybe just walk over it.
That's right. And those who've been doing this long enough look at that and say, yeah, I know those numbers are coming down, but I'm pretty sure management's sandbagging that guidance. That's number one. Number two is probably in the political realm for your political commentators to get into, but it's the fact that Trump blinked, if you will, and responded to the dynamic, some would say, of the bond market. Some would say it was the stock market. Others would say it was something entirely different. Who knows? But nevertheless, there's a signal from the policymaker that they are responsive, that they are subject to change. And that's a good thing for the markets. And that forces all of this money on the sidelines to come back in and say the world's not ending, right? And then finally, I would say that earnings revision being so negative, the market's going up, companies are also, I think they took this as an opportunity to really remind investors what kind of shape they're in. So what do I mean by that? Been around doing this for a while. Pre-pandemic, companies were in good shape. I would say they were lean, but they weren't agile. Now the pandemic, I think of that as really like a corporate boot camp, a brutal corporate boot camp. And you've got these, call it interest rate hikes. You've got these inflation sprints, right? You've got these supply chain shocks. Not all the companies survived, but the ones they did became lean and mean and agile, able to handle every crisis. And so today, I think they had an opportunity to remind through this reporting season investors that, hold on, all of this muscle we've built over 5 years, we have it. And these tariffs might be less than ideal, but we have a pretty strong playbook for how to respond. And I think people said, yep, you know what, I forgot about that. We're in good shape here.
When I take a look at the S&P 500 as we started our discussion over the past month, the swoon, the recovery, in hindsight, I say, oh, we recovered. But those first couple of weeks of April, that tested a lot of people, a lot of questions coming in the show, but what should I do? What's the importance of a process when we go through something like this?
Well, the importance of a process is that you stick to it. And if it's a good process, it not only keeps you in the market, but it gives you an opportunity to buy dislocated stocks or whatever investment instrument you're looking for. And so, speaking from the heart and speaking from our team, we have 20 plus research analysts whose day job, day in and day out, not from a weekend job, is to study these companies, these industries up and down, in and out. And then you follow a process for stock selection that's very closely tied also to valuation and what you think you're paying relative to the intrinsic value of a business. So when markets panic and there's dislocations, you're in a position to go and say, yep, that's overdone, I like that. Or, you know what, this company's particularly vulnerable, maybe we shouldn't own that, right? So we, truthfully are, of course, stressed out in environments like this, but it's our time to shine, and it's an opportunity. It increases the competitive advantage for professional asset managers with a rigorous process. And I would say to your viewers is, whatever their process is, whoever they invest with or however they invest, make sure that you're using this crisis to hone your investment skills, improve your acumen, and develop that process that keeps you from succeeding and keeps you from panicking when times really become quite dire.